A shoemaker's son who started in the mortgage business as a teenage messenger boy built the largest home mortgage lender in the United States, and in doing so, personally helped originate hundreds of billions of dollars in loans that would eventually become a central symbol of everything that went wrong in the 2008 financial crisis. His name was Angelo Mozilo, co-founder and longtime chief executive of Countrywide Financial. Born in the Bronx in 1938 to Italian immigrant parents, Mozilo began working in the mortgage industry at 14, delivering documents for a small mortgage banking firm, and eventually co-founded Countrywide in 1969 with a specific ambition: to build a mortgage company that could operate efficiently at massive scale, serving ordinary American families who wanted to buy homes but weren't always well served by traditional local banks. For most of Countrywide's history, this mission was genuinely admirable and, by most measures, successfully executed. The company grew steadily for decades, becoming known for using technology and standardized processes to make mortgage lending faster and more accessible, eventually growing into the largest mortgage originator in the country by the early 2000s. Morgan Housel has written that companies often drift from the specific discipline that originally made them successful not through a single dramatic decision, but through a gradual, incremental loosening of standards that each individually seems reasonable in the context of a rising market, until the cumulative effect of all those small compromises becomes genuinely dangerous. Countrywide's specific drift occurred during the housing boom of the early to mid-2000s. As competition for mortgage business intensified and housing prices continued climbing seemingly without limit, Countrywide progressively expanded its lending into increasingly risky mortgage products, adjustable-rate mortgages with low initial teaser rates that would reset significantly higher after a few years, loans requiring minimal documentation of a borrower's actual income, and mortgages issued to borrowers with weak credit histories who would have been denied loans under the company's own earlier, more conservative lending standards. Benjamin Graham's investment philosophy emphasized that lending, at its core, should be based on a careful, honest assessment of a borrower's actual ability to repay, a principle Countrywide's own internal practices increasingly abandoned as volume-based growth targets took priority over careful underwriting. According to subsequent litigation and internal company documents made public through legal proceedings, Countrywide's own internal risk management teams raised concerns about deteriorating loan quality standards years before the company's ultimate collapse, concerns that appear to have been overridden by leadership focused on maintaining Countrywide's market-leading loan origination volume. Daniel Kahneman's research into how financial incentives can systematically distort professional judgment, even among people who genuinely believe they're acting responsibly, helps explain much of what happened inside Countrywide during this period. Loan officers throughout the company were compensated primarily based on loan volume rather than loan quality, creating a direct financial incentive to approve as many mortgages as possible regardless of the borrower's genuine capacity to repay, an incentive structure that, multiplied across thousands of individual loan officers making thousands of individual decisions, systematically pushed the entire organization toward progressively riskier lending, even without any single individual necessarily intending fraud. One particularly notable detail that emerged through subsequent Securities and Exchange Commission litigation involved Countrywide's Friends of Angelo program, through which the company reportedly extended preferential mortgage terms to politically influential figures, including several members of Congress, raising serious questions about whether the company was using favorable loan terms to cultivate political relationships and influence that might benefit Countrywide's broader regulatory and legislative interests. This specific program became a significant point of public and regulatory scrutiny once details became widely known. Robert Kiyosaki's core lesson about understanding exactly what generates a business's genuine, sustainable value applies here with painful relevance. Countrywide's reported profits during the housing boom reflected enormous loan origination volume, but a substantial portion of those loans were fundamentally unsound, dependent entirely on housing prices continuing to rise indefinitely to avoid triggering widespread defaults. The company's reported success masked a genuine underlying deterioration in the actual quality of the loans generating that reported success. As the broader housing market began declining in 2007, Countrywide's loan portfolio, heavily weighted toward the riskiest categories of mortgages the company had originated during the preceding boom years, began experiencing rapidly rising default rates. The company's financial position deteriorated with alarming speed throughout 2007, and in January 2008, facing imminent collapse, Countrywide was acquired by Bank of America in a deal that, while preventing an immediate bankruptcy, ultimately proved enormously costly for its new owner, who inherited billions of dollars in eventual legal liability and losses connected to Countrywide's lending practices during the years leading up to the acquisition. It's worth pausing specifically on the internal culture that allowed this drift to accelerate as dramatically as it did. Former Countrywide employees who later spoke publicly, including in subsequent litigation and journalistic investigations, described an internal environment where loan officers who raised concerns about specific borrowers' ability to repay were frequently overruled by underwriters and managers under pressure to keep loan volume climbing, and where the company's own internal slang reportedly included derisive nicknames for certain high-risk loan products that made light of exactly how poorly documented and verified they actually were. This detail matters because it illustrates something Housel has written about elsewhere. Organizational cultures rarely announce a formal decision to lower standards. Instead, standards erode through countless small, individually defensible daily choices, each one slightly more permissive than the last, until an outside observer looking at the cumulative result would be genuinely shocked by how far the organization had drifted from its original stated principles, even though no single person inside that organization experienced the drift as a single, dramatic moment of compromise. This pattern is worth remembering specifically because it doesn't require anyone involved to be a cartoonish villain. Most of the individual loan officers, underwriters, and even many mid-level executives at Countrywide likely believed, at each individual decision point, that they were simply doing their job competently within the rules and incentive structures the company had established. The genuine danger wasn't any one person's individual dishonesty. It was an incentive system that made progressively riskier behavior feel locally reasonable at every single step along the way. Here's an honest complication worth including, since the legal accountability for Countrywide's specific practices proved considerably more complicated than many observers expected given the scale of harm involved. In 2010, Mozilo agreed to pay approximately $67.5 million to settle civil fraud charges brought by the Securities and Exchange Commission, specifically related to allegations that he had misled investors about the deteriorating quality of Countrywide's loan portfolio while personally selling significant amounts of his own Countrywide stock. Notably, this settlement resolved civil charges rather than criminal ones. Federal prosecutors ultimately declined to pursue criminal charges against Mozilo, a decision that drew significant public criticism from those who felt the scale of harm caused by Countrywide's lending practices during the housing crisis warranted a more severe legal consequence than a civil financial settlement alone. George S. Clason's advice about the fundamental danger of debt taken on without a realistic capacity to repay it applies here at an industry-wide scale that Clason himself, writing about individual borrowers a century earlier, could scarcely have imagined. Countrywide's specific lending practices during this period represent one of the clearest illustrations in modern financial history of what happens when an entire lending industry systematically abandons the basic discipline of verifying a borrower's genuine ability to repay, in favor of maximizing origination volume during a period when rising asset prices temporarily masked the underlying risk being generated. This isn't a simple story blaming one company or one executive entirely for the broader 2008 financial crisis, which involved contributions from numerous institutions, regulators, and market participants across the entire financial system. What makes Countrywide's specific story worth remembering is the particular pattern it illustrates. A company that began with a genuinely admirable mission gradually drifted, through a series of individually rationalized decisions rather than one dramatic choice, into practices that ultimately caused enormous harm to both the borrowers it had originally set out to serve and the broader financial system its lending practices helped destabilize. So here's a question worth sitting with. In your own work or business, are there small, individually justifiable compromises accumulating gradually that, taken together over time, might represent a meaningful drift away from the standards you originally set out to maintain? Before you leave, I want to hear from you. Have you ever recognized, in hindsight, that a series of individually reasonable seeming decisions had gradually led you somewhere you never would have agreed to go if presented as a single, upfront choice? Read a few comments before you go. Some of the most reflective stories on this channel come from people who've recognized exactly this kind of gradual drift in their own decisions before it became genuinely serious. Next week, I'll feature one thoughtful comment at the beginning of the video and send its author one of the books that inspired this channel. And if these documentaries help you think differently about money, you'll find a way to support future research in the description. Every contribution helps us buy books, access research, and keep this content free for everyone. Remember this: Countrywide didn't collapse because of one bad decision. It collapsed because thousands of individually reasonable seeming decisions, made under the pressure of a rising market, quietly added up to a company that had forgotten what it was actually supposed to be verifying in the first place.